Okay, good afternoon and welcome to this hybrid meeting of the Special Scrutiny and Audit Committee. I would remind all attendees that the meeting is being recorded and webcast live on the Council's YouTube channel. I've agreed the attendance of some members remotely and would remind all remote attendees to mute their microphones when not speaking. And for any members of the public watching, please note that all public committee reports, including details of specific recommendations, are available on the Council's website. So we'll move to the agenda. This is, as you're aware, a special meeting to look at the Council's accounts before the appropriate deadline, which I think is the end of this month. That's why it's been called. So apologies and substitutions.
Thank you, Convener. We've got no apologies and no substitutions.
Okay, thank you. Any declarations of interest and statements of transparency? Okay, I think that's a no. So we'll move on to the meat of the meeting. Scrutiny, item 3, the 24-25 unaudited annual accounts, and I'll hand over to Ian Lorimer on that one.
Thank you very much, Convener, and good afternoon, elected members. Yep, this report covers our 24-25 unaudited accounts. As required by legislation, those have already been submitted to the Controller of Audit for audit purposes by the 30th of June deadline. And as you mentioned, Convener, the reason we're having a special Scrutiny and Audit Committee today is that the Scrutiny and Audit Committee must consider those draft accounts before the end of August, also a statutory requirement. So the accounts, they cover everything to do with the Council's finances and our financial position at the end of March 2025. The accounts, if you've had a look through them, they are lengthy, they are quite a technical document. So we are bringing a summary report to Policy and Resources Committee next month, looking at the revenue and capital budget outturns on I guess, a less technical basis than is explained in the formal accounts. So the accounts are here today for the committee's consideration and scrutiny. As I say, there's a lot of information in the accounts. A lot of that's technical and regulatory things that we need to report on under the accounting code. All 120 odd pages of it. I think I would always generally point non-accountants to the management commentary that's in the accounts. It sets out quite a bit of background around the council and the council plan for, I guess, non-experts in relation to that. And just briefly in terms of that management commentary, it's kind of split into about 4 sections. There's a section which is section 4, page 3 onwards in the document, the actual accounts document, provides an overview of the council plan. All of that will be familiar, and there's some information there about performance measures. We're bringing a more detailed report around performance to the committee next month. Sections 11 and 12, page 14 onwards, they give a bit more detail on the Council's financial performance for the year, covering general fund services and housing services. And then section 13, which is page 19 and 20 of the document, there's a summary there of the position in relation to the Council's reserves and the various commitments against those. And a relatively new addition in the last few years, section 17 of the management commentary, page 21, is a forward-looking operational and financial overview. So looking ahead at some of the challenges that we face. I'm not going to attempt in my introduction to summarise 127 pages of information. You'll be glad to hear. But just a couple of things to pick out that may be worth mentioning. Our general fund reserve for the year saw a decrease of just over £16 million, so quite a sizable decrease on the general fund reserve, and a just over 600,000 decrease on the housing revenue account. Don't worry about those. Those were planned reductions that we'd intended to make. There was, across all of the general fund revenue budget, a favourable variance, not a significant one in net terms, but a favourable variance that we had on the year, and that was an improved position than what we had projected we would have when we set the current year's budget. But where we ended up on that was, in net terms, only £83,000 of an increase in our uncommitted general fund reserve. So we're more or less where we thought we would be when the current year's budget was set. There's information in the document as well about our capital programme. There was tens of millions of pounds invested across Angus last year towards various capital projects in both housing and non-housing projects. On the general fund side, the net spend was just over £37 million against a full year budget of £47 million. And then on the housing programme, we spent just over 8.6 million against a 12 million or so budget. So a bit of a mixed picture there in terms of the capital position for the year. The Council's general reserve, as I said, is now sitting at just over 44.6 million, which is marginally more than what we had expected it to be. Our overall net asset position as a council, looking at the council's balance sheet, decreased by just under 24 million for the year, and there's a variety of reasons for that, which I'll not go into. In terms of the actual core statements and the supplementary statements, just to give a little bit, so the document that you have in front of you, it looks, as well as the management commentary, remuneration report, annual governance statement. In terms of the financial bits, we've got a comprehensive income and expenditure statement, we've got a movement and reserve statement, a balance sheet, cash flow, and then a number of notes to the account. So that's kind of how the thing breaks down, and then there's a number of additional what we call supplementary statements covering things like the position on housing revenue account, council tax income, non-domestic rates, charitable trusts and common good. It's all in there in terms of that 120 odd pages. The other thing which I wanted to do today, one of the major changes to the annual accounts for this, for 24-25, relates to the introduction of something called IFRS 16. So International Financial Reporting Standard number 16, which covers leases and what we call right of use assets. Now, IFRS 16 has been around for a few years. It's already applied in other sectors, but its implementation in local government in the UK has been delayed until financial year 24-25. Now, I did previously say that I would do a briefing for members on this new standard, but when I thought about that a bit more, I thought I could just provide a little bit more information today, which might be more helpful because it's part and parcel of the accounts that are before the committee today. Now, this is a little bit technical, but I'll try and keep it as non-technical as I can. So in simple terms, IFRS 16 changes how we have to account for assets that we lease to deliver our services. Historically, leases were classified as a finance lease, where the terms of the lease transferred substantially all of the risks and rewards associated with ownership of the asset to us as the lessor, and anything that wasn't counted as a finance lease was regarded as an operating lease. Operating lease arrangements, the transactions associated with that were not included on the council's balance sheet. IFRS 16 takes away that distinction. So everything, if it meets the tests, whether the operating lease, finance lease distinction just falls away. So what that means is that we're now recognising a little bit more in the way of assets and liabilities on our balance sheet for leased assets. And it's only those that are where that arrangement is in excess of 12 months. So under IFRS 16, a lease is defined as a contract or a part of a contract that conveys the right of use of an underlying asset for a period of time. So in our 24-25 accounts, we have applied, because we're required to under the code, the IFRS 16 requirements. That's the first year that it comes into being. And I suppose the long and the short of all of that is that it changes the value of our assets and our liabilities to reflect the new ways of measuring these assets. IFRS 16 has been applied retrospectively, but with the cumulative effect recognised at the 1st of April. So it's the opening position that we've recalculated. So what that means is that although it's a new standard for us, the way that it's been applied in our accounts is as if it had always applied, rather than having to go back and adjust prior year figures. What does it mean in numbers terms? Not a massive amount of change. So our property, plant and equipment assets under the new standard have gone up by 2.7 million, and our creditors, our lease liabilities have gone up by the same number. So it's not, I would say it's been a huge amount of work, but its impact on our balance sheet has not been hugely significant. When you consider our net assets are over 700 million. So it's relatively small in terms of the impact. The more significant impact is in relation to what we call service concessions. Those are the assets that we have acquired under PPP and PFI contracts. Those also require to be remeasured at the introduction of IFRS 16. That has also been a significant amount of work. And it's a remeasurement of the liabilities arising from those arrangements. And that also uses an indexation at February each year to do the recalculation. So that's one that would need to be recalculated every year. The adoption of IFRS 16 required that the balance on all of our PPP, PFI arrangements on an initial application be remeasured to reflect the carrying amount of debt liability based on the index applied to the variable payments in the previous reporting period, which was, as I say, was February. And then they've been remeasured in accordance with IFRS 16. What does all that mean, Ian? Well, the liability that we had across our 5 service concession arrangements at the 31st of March 2024, before IFRS 16 came in, was just under 106 million. The remeasurement on the 1st of April 2024 under the new standard increased that liability to just over 131 million, so about 26 million of an impact. The liability then gets remeasured again at the end of March 2025, and that it's come down a little bit. So our liability position, I suppose, at the end of all of that has moved from 105 million to 129 million. So it's a bit more significant in balance sheet terms for the service concessions impact than it is for the lease transactions. I'm going to stop there. You'll be glad to know, because it is a fairly technical thing. But I hope that brief introduction has been helpful. We are still at the position of the audit is still underway on the draft accounts, but we will bring back to this committee next month the audited accounts for formal sign-off. Hopefully there won't be any significant changes to the position. IFRS 16 is new, so that could be an area that you know there's changes arise on, but we'll just need to see what comes from the audit. Happy to take any questions today, and equally happy to speak to members separately if that's easier, if there are particular questions on some of the more technical or detailed aspects. Thank you, Convener.
Thanks very much. I have got 2 questions in the chamber, Councillor Bell and Councillor Devine, and I'm happy to look for other hands up. I don't see the money at the moment, but over to Councillor Bell for the first question.
Thank you, Convener. I'm going to sneak in another wee question, because you reminded me that when you were giving us the heads up around IFRS 16, I was concerned about staff capacity to deliver on that, and I just wondered, first of all, has that manifested itself? Has that caused problems in other areas for staff, and how are they being supported? But my main question was actually around the HRA information, if anyone can help me on that, and it might just be how the narrative is built, so forgive me. On page 19 of the combined papers, under item 12, it says that there was 0.609 million on new council housing provision, and the children's residential home purchase is collected separately there. So if we move on the actual accounts, if you don't mind, I've got a question there. On the page 118, under housing stock at the bottom of the page, it talks of there's no new build listed, and acquisitions, conversions, total 3. So I just wondered how those figures match up. When it says originally there's new council houses, and then it's acquisitions and conversions. So I'm not 100% sure what's captured in there for the 609,000. Thanks.
Through you, Convener. Thanks, Councillor Bell. I'm not sure on that one in terms of that particular note. So that note is looking at the movements on our housing stock, as you say, and there has been spend. Can I come back to you on that one? I'll check what the detail of that is. I see what the nature of the query is, but I'm not sure of what the answer is. So I'll come back on that one. In terms of the staff capacity question, it has been a significant amount of work, and I would pay tribute to my colleague Darren O'Shea, who's done a huge amount of work in relation to the IFRS 16 implementation. Which has really put us in a good place. So I pay tribute to the work that Darren has done on that in this particular year, including on the service concessions. It's really technical, and Darren's done some excellent work on that. So it has been a challenge. We've got there, subject to any views from the audit process, but we're pretty happy with where we've landed on that. Thank you.
Okay. Councillor Devine.
Thanks, Convener. It's just about SFRS 16 and the PPP schools and things and roads. Now, we're still paying back on these, aren't we? What happens in the future when they come back to us and we're not paying any more money out? Do they still have to be accounted for in the same way?
Yeah, thanks, Councillor Devine. Yeah, that's the nub of what's going on here. So our PPP PFI arrangements, there's no change to what we pay the PPP PFI company. So our contractual payments under the legal agreements are unchanged by the service concession accounting changes that we made. So we're still paying out the same amount of money and cash. However, in accounting terms, and just kind of go back a stage. So if we were building a new school, we were funding that through conventional borrowing by the council, we would write off that debt over 40, 50 years. But if we take a PPP school, most of those are, I think, a 30-year contract. So we're paying for the whole creation of the asset and its maintenance over a 30-year period. So the accounting change allowed us to spread the cost of creating the asset over what we would regard as a more normal period. So that was the change that was brought in a couple of years ago. IFRS 16 changes that in terms of how we do the measurement, but the same principles apply in terms of we still pay the contractors what we've always contractually been obligated to pay, but in our accounts we show a different position to that spreads the cost of the asset creation over a longer period. Does that help? But it won't. So you'd also asked about what happens when those assets come back. There are handover provisions in all of the contracts, which means that those assets should have a useful life beyond the contract period. We would then no longer be paying the PPP contractual payments, although we would still have a cost in our accounts. But we would then also we wouldn't have those contractual payments, but we would be responsible for ongoing maintenance. We would then pay for that.
Okay, thank you. Any other questions? Okay, I've got a question which relates to page 16 of the Comprehensive Income and Expenditure Statement and the summary for that. It really is just to ask Mr. Lorimer to explain. So we do our budget and we try and produce a balanced budget. We bridge the gap between income and expenditure by use of reserves and council tax increase. And as Mr. Lorimer said, we've had a pretty good year where we've basically stuck to the budget. However, we're still showing a deficit on provision of services of 19.7 million, and that I think that's reduced to 16 million, and then that is reduced from our available balances effectively. Just to explain that the treatment of that, because it's a wee bit tricky, and for us non-accountants.
I agree. So, and a number of the notes in our accounts are to try explain what's going on. So the 19.7 million deficit on provision of services that you see on page 16 of the document, that's the accounting deficit if we follow all of the kind of standard accounting practices. However, there are then adjustments and mitigations that are applied so that the impact on the bottom line and effectively the council taxpayer is mitigated. So some of the transactions that go through on the comprehensive income and expenditure account are in the real world notional. We have to show them that way because that's the proper way to account for them. But they are then reversed out to get to effectively the real bottom line impact on the council's financial position. So the note, I think it's note 5 to the accounts, which is, I did bookmark it and now I can't find it, is on page 65 of the accounts. Is our, and it's still quite a technical table, but that's us taking it from the accounting basis back to I suppose what does it mean in terms of the council's finances. And you can see from that there are multiple adjustments for things including depreciation, revaluations on property, plant and equipment, etc. It's one of the things that makes the council's accounts more difficult to follow. But I would describe it as there's the kind of, that's the accounting deficit, but in terms of what that then means for our bottom line and for council taxpayers, there's a number of adjustments that are made that actually mitigate and reduce that number. I hope that helps.
Yeah, thank you. So that the take-home message is the council taxpayer doesn't have to fund the council's depreciation effectively. Yeah, among other things, yeah. Okay, thanks for that. Any other questions? Okay, I'm not seeing any. Okay, so I think today we are asked to note and scrutinise. I think we've had a few questions, so we have scrutinised and we are noting the accounts. And I think that draws the meeting to a close. So thanks for your attendance and have a good, enjoy the sunshine for the rest of the day. I think it's going to rain here, but okay, thank you.